The Trump administration has followed through on its threat to place sweeping tariffs from goods from Canada and Mexico and higher tariffs on China. Well, the Canadian government and China responded with retaliatory tariffs. Mexico will respond this coming Sunday. But we should point out that the situation obviously very fluid, and what we know true to be today may not be true tomorrow. Well, here to walk us through all the economic implications of this, TD Deputy Chief Economist Derek Burleton. Derek, no easy task, but of course we know what we know at this given moment. Thanks for joining us. So the tariffs have materialized. How do they start to impact both the Canadian and U.S. economies, and how soon do we feel it?
Yeah, I mean, the fluidity of the situation makes it a little challenging to assess, and we'll see where we stand in a day. But I think what I would say is any prolonged significant tariff is stagflationary for both Canada and the United States, albeit in Canada, the worry would be a bit more on the stag part of that equation. In the U.S., given the economy wouldn't be hit as hard, it'd be more worries about inflation. So a little bit of you'd have to distinguish on that front. In terms of when we would see the impacts, what we've seen is a lot of front running of the tariffs in terms of an explosion in Canadian and Mexican exports to the United States over the last few months. That'll mitigate some of the immediate impacts, but not for long. I think on the inflation side, pretty quickly we'd start to see food prices rise. I think autos is more interesting, particularly under a lower tariff environment, say a 10%, that producers would take that haircut early and then pass on prices over time. I think growth, for Canada, it's very much a second quarter story, where not only do you get exports pulling back from a strong Q1, but then you start to see the effects of delayed investment, and wouldn't be surprised to see a contraction in the economy in Canada. So, bottom line is the effect should happen quite quickly.
So you see a contraction in the Canadian economy. Obviously, the central banks will be keeping an eye on this, and perhaps even in the U.S. So what do the central banks do with this information? We have a decision next week from the Bank of Canada, don't we?
We do. Yeah. And, stagflation for a central banker is not a great, enviable environment to be in. You think about the Fed, for example, where the economy isn't getting hit too hard. Certainly we'd be taking down growth in a 25% tariff environment, blanket tariff, even in a somewhat lower tariff, taking down U.S. growth. But again, inflation would be something the Fed would be worried about. And I certainly wouldn't be surprised to see a Fed having to hike rates.
Wow.
If the tariffs are prolonged for, say, 6 months to a year, they might even have to take their rates up. Certainly rate cuts that we have in our current baseline would be off the table. In terms of Canada, I think they would ultimately end up trying to shore up activity through lower rates. Again, would depend on how long the significant tariffs remain in place. And I think initially they might be a bit cautious. I still expect a cut next week. I think the market does. But heading into the spring, if inflation begins to rise as we expect towards 3%, do they then have to say, okay, I'm going to pause, let's look at fiscal response, assess that, and then, assuming the economy were to weaken, then they'd have to cut more aggressively than we expect. So the 3 cuts we have, starting with next week, could be certainly deeper in a prolonged tariff environment.
When we talk about shocks to our economy, central bank reactions, we have to think about what this could mean for our currency, the loonie. How do you see it in the face of all this?
Well, it's interesting. I would have thought the Canadian dollar in recent days would have been significantly lower given the actual implementation of tariffs. I don't think that was fully factored in. What I didn't foresee was the U.S. dollar weakening broadly on global currency markets. Tariffs, all things equal in the ECO 101, should strengthen the U.S. dollar and weaken other currencies, given they're the big net importer imposing the steeper tariffs. It hasn't been working out that way, and I tell you why. It's because of growth worries. The timing of the tariffs is hitting the U.S. at a point where economists and markets are now increasingly worried about downside risk of the U.S., and that's what's driving the U.S. dollar down. I don't foresee that, as long as the U.S. doesn't roll over as we don't expect it will. That'll be a short-term story. U.S. dollar strengthening, heading deeper into the spring, and a Canadian dollar weakening. And under a significant 25% tariff, say, a mid-60s currency is certainly well within the realm. So quite a bit lower currency than what we're currently seeing.
Of course, in all this, the federal government and the provincial government's keeping an eye on what's going on, and they have made rumblings about supporting Canadians or industries through this. What would you expect the role of government to be in all this?
Well, it's interesting because already they're communicating, pulling out the pandemic playbook, and they're not holding back. They're saying they will be there to provide support to the economy. A few things for sure will happen, as they did back in COVID, was enhancing EI, looking at job sharing programs. These are all relatively lower cost ways of providing immediate, quick support. The infrastructure's in place. It's been tried and tested. So that's one thing. I think then it gets into, okay, what other policies might be implemented? It would depend on the scope of the challenge, of course, how high the tariffs are, whether there are other tariffs on top. They could look at wage subsidies again. That was a program that they used during the pandemic, focused on the most affected sectors and maybe broadening it if we get second order effects. That's quite an expensive program because we found in COVID they had to really loosen some of the restrictions so employers actually took advantage of them. But you get into things like CERB, see that less likely, nor do I see that being the right tool for the job. One thing we learned, it can be inflationary once the crisis settles down a bit, and that's something we don't want to see. So we'll see a lot of support. I think it'll mitigate the downside. I think it really does come down to severity of the challenge.